go to the system part, we'll log into the system and we'll explain one by one. If you have question, please ask us, because otherwise you might not get an idea about this one. You are the one who knows that in branch, what are the difficulties that you are having once you are registered. So if you are telling the problems, we can cater them and we can give them solutions. So this is the path that if someone is onboarded and customer has to go in this path. So if you register customer, that means if you onboard a customer to the CIB platform, how it works, you should know how it works. So customer can visit peoplesbank.lk, our main website login page, and he can go to the online banking system. So once he visits, you can see this web browser. This kind of window will be appeared, and he has to give the corporate ID first. So what is the corporate ID is mentioned in the application form when you are sending to a registration process. So he can select the corporate ID here and username next. That means if there is 5 users, the user A can log by using his username, and the next one is a security feature. He has to give that code number same as in there, and going to the next one. So when he going to the next window, he has to give the password that he has given to the system. That this password has been sent by our team, that means digitalization department. Once the customer registered on board, we are sending the password to the email, his email. Once he give the password, the next window will appear and it's asking the OTP. So within the given credentials, that means the email or mobile number, he can select whatever is convenient for him, and same time they will receive OTP message to their phone or email. So after that, he has to accept the terms and conditions first time. When he's logged into the first time only, he has to do this, and he has to accept that. And next one, the which I have talked earlier, that the the phishing image, he has to select from this one. So he knows exactly when he's logging that the next time, he knows that this phishing image will be appeared in his system. And also he has to give the password according to the details we have given in the section below. He has to select his own password and he can log into the system like this. This is for the first time login. So now we'll log into the system and show how the functionalities and the things are working. This is the main page, and we are logging into the system by online banking system. The same like the people's, if someone wants to log into the retail instant banking, the same like that. There is a module section, the button is corporate internet banking. We are clicking on that and going. So CIB login page is like that. So you can see that corporate ID is here and username and verification code is there. And you have to give the password of the user. This is the phishing image that you have selected earlier when you are registering the one time that we already selected this. Right. Once you give the password, you can give the OTP selection from here, and you can select even SMS or email. Yeah, once you give the OTP, you are going inside the system, and so you can see the functionalities inside the system. See how many functionalities are there. So customer actually he doesn't want to come to the branch. Once you go through this one, you will feel that how easy and convenient to the customers. They can do by themselves all the transaction without coming to the branch. The first one, you can see, everyone can see, right? The first functionality is the account service one. So you know that how many calls are coming in the morning. If it is a Monday, how many calls are coming to the branch asking the account balances, current account balances, and checks, unrealized check balance or old amount or whatever. How many calls you are answering and wasting your time to give this information to the customers. So in this case, customer can see his accounts, all the accounts listed under his CIF. So customer doesn't want to go to the branch and ask the every and each information from the branch people. In this one, all the accounts are listed here, and also he can select by category wise as well. If he wants to see the current accounts under his profile, he can select the current account tab. And if he wants to see the loan accounts, he can select by this product. There's one loan. So you can see how easy is that, and we'll go to that in detail, and we'll show that how it works. And also in this section, if the customer wants to get all accounts information in one file, he can take that printout from here.
Hello, good morning.
Good morning, sir.
I think there was some connection problem with somebody else, delivering a lecture. Did you all hear that?
Yes, sir.
What is that? Is it our participant connected to another lecture?
I don't have any idea. That's why I was confused. Maybe others also would have heard.
Sorry?
There was no idea, sir, because when I was joining also, I heard the same kind of presentation.
Is he our participant or?
Maybe
No,
Institute
anyway,
can,
now, no, anyway, now it's, disconnected, no?
yes,
Ah, okay, okay. Can you all see the presentation? Can you all see the presentation?
yes, in the presentation, not in the presentation mode on this
Yeah, yeah,
screen.
I know exactly. Now, can you see?
Still same.
You can, no?
Yes,
Are slides moving?
no, sir.
No, sir.
Ah, okay. It's still in the first slide, no?
Yes,
Now,
still not moving.
still not moving. Okay, then. Can you see this slide?
Yes, sir.
Huh?
Yes, sir. Can see.
Okay, Basel 1. Okay.
Banking Act Direction number 1 of
Sorry?
2016. Yes,
Okay.
the heading is Banking Act Direction number 1 of 2016.
Okay. Now moving, no?
Yes.
Okay, are you all there in this page? Banking Act Direction number 1 of 2016? Okay. Are you all there? Okay. Are you all in the Banking Act Direction number 1 of 2016? Can't hear?
Yes, sir.
Okay. Uh, okay, before we start, okay, let me recap what we did last time. Okay, if you don't hear or if you see some problem with this slides moving, please stop immediately. Don't wait till last minute because I really don't know what is happening on the other side, your side. So basically what we discussed last time, how Basel, code tried to address different risks a bank face uh, and how different standards set to mitigate such risk in terms of capital. So that was what we discussed last time, and how it started in 1988 with implementation of Basel 1, which broadly covered credit risk, and then moved to Basel 2, and now we are in the Basel 3, where majority of risks are covered. So that internationally, banks are the regulators require the relevant banks in their respective countries to follow Basel standards, subject to modification as per their needs. So each country has their own standard, but in line with Basel international standard, but with some modification to suit their country requirement. So if I go back to Basel 3, which is applicable right now in all over the world, what are the key changes in Basel? In fact, if I go back to Basel 2, so what are the three pillars Basel 2 mentioned, and what were the objectives, or what are the objectives? Basel 2, three pillars. I think that is the main discussion we had last time. So if some of you can, state what is Basel 2, and what are the objectives under each pillar, and then how we move on to Basel 3. So there are 3 pillars. Basel 2, I think, can we get some responses from our participants? Anybody? 3 pillars we discussed. Can someone come up with, answers? Suresha?
The minimum capital requirement, supervisory review process, and market disclosure.
Minimum capital requirement, other one?
Supervisory review process, and the third one is market disclosure.
Okay. Okay, minimum capital requirement, what are the objectives and what things specified?
Credit risk, market risk, and operational risk.
Yeah, so what it specified? In order to cover credit, market, and operation risk, the Basel set minimum standards for capital adequacy for both the core capital and the total capital. So they set 2 minimum standards, okay? Then anyone else, supervisory review or the pillar 2, what are the objectives? Anyone else? There are others who... Can we hear from someone else? This is what we discussed last time, not too long. Kasturi? What is Basel? If you I see some names.
It's mainly talk about what is not fully covered under the pillar 1 and the what are the risks not covered in the Basel 1.
Okay, risk not covered fully in Basel, in pillar 1, also not fully covered, risk covered but not fully covered, and also all other risks. Okay, so can you give some examples of such risks?
It's talk about the bank strategy, what are the risks they are having it, the reputation risk of the bank, and the some what is the interest rate book and the book of what is book value of the interest.
Banking book risk, banking book interest rate risk, because the pillar 1 only talks about trading book interest rate risk and trading book equity risk. Okay, so basically it covers all the other risks and the risks not fully covered in the pillar 1, such as interest rate in the banking book. And also there's a specific importance given to the capital there. So there's a specific capital, the pillar 2 focus. So what is that? Anybody?
It's about the concentration risk in the particular.
No, I'm asking no, specific capital. The pillar 2 is focused on specific capital. What is that called? Objective pillar 2 is specific capital for any banking institution. Anybody else anybody else can answer. Because pillar 1 covers one sort of capital, pillar 2 basically a different concept. So I am asking what is that capital we call? Open for anybody. Economic capital. If you look at pillar 1 focuses on regulatory capital. So which sets the minimum capital requirement across the board. So anywhere, any country, any bank, the regulator set Okay, this is the minimum regulatory capital which covers, which should cover credit, operational, and market risk. So that's the bare minimum. But economic capital, which is the main concept under Pillar 2, which is beyond the regulatory capital. So it is up to the bank to do a clear assessment of all the risks a bank face at present and in the future, based on its strategic business model, and come up with what is the right amount of capital above the regulatory capital. So this is a classic example I mentioned. If you are on the road in a highway, even though the regulator set the max limit of 100, it doesn't mean all of us can go in the same speed. That all depends on our conditions and our capacities. So we set our own limit despite regulator allow us to go at 100. Similarly here, regulator sets a minimum standard, but we should decide what is the right capital level to cover up my all risk. So where which is measured through a specific way. What is that we call? What that process is called? This is all what we discussed last time. ICAP, if you all can remember, ICAP, Internal Capital Adequacy Assessment Process or Program. So when a bank does ICAP, bank comes to an understanding of the actual capital bank should meet on top of the regulatory capital, and regulators can see whether the bank has done a proper assessment. That's the whole concept behind the supervisory review process, the economic capital. We discussed at length. There are 4 principles under supervisory review process under Pillar 2. The bank required to do own assessment to identify their minimum capital requirement, own capital requirement. Bank should continuously monitor. The regulator should continuously monitor and assess. Then bank should always run with capital above the minimum capital. And the 4th principle is regulators should react whenever they find capital is declining of a bank. Then can someone explain what the objective of Pillar 3? Pillar 3. Can someone tell about Pillar 3? Pillar 3 was the objective. The market discipline. So basically, market discipline is again a transparency about the risk management and the adequacy of capital to cover risk in a banking institution and disclose it to the public. So that the public who conduct business with a bank comes to know the risk a bank face at present and potential risk bank would face. So the public and the other stakeholders can take appropriate rational decisions in transacting with a particular bank. Okay? So that is Pillar 3. We didn't discuss Pillar 3 disclosures yet. We will probably discuss today. Then, so that is the principles that brought in Basel 2. But again, in the Basel 3, since the crisis took place late 2007, 2009 period, the committee decided to improve the capital levels further to ensure the quality of the capital. So what are the key improvements suggested in the Basel 3 in terms of capital? Can someone explain what are the improvements made in the Basel 3 in terms of capital under Pillar 1, and thereafter what other things? Can someone tell quickly? Puresha?
So additional buffer was introduced with this 2.5%.
Okay, what is that you call it?
That is,
Capital conservation buffer.
yes, capital conservation.
Then what else? The two buffers, additional two buffers on top of the enhancement of capital. So those two has been, one is capital conservation buffer, that is minimum 2.5% conservation buffer in terms of common equity tier 1 capital. And then again, the other one was what is a counter-cyclical capital buffer, which is not set at all times whenever the banks, the regulators or the government see in respect to countries excessive credit growth, which could disturb the market subsequently and lead to a particular risk. To cover up that risk, building some buffer, counter-cyclical buffers, ranging up to 2.5%. So that is called the counter-cyclical buffer. Whenever regulators feel that excessive credit growth and it will be followed by a recession impacting the banks, which usually sets at the national level across the board. But before that, what are the improvements suggested for the capital under Pillar 1? So there were changes to the structure of capital and also the levels were enhanced. What are those? Anyone? So this is what we discussed last time. It's not too long. Yes, Rash. Anybody? Reshma? Anybody? Anyone? What was the improvement suggested? Asturi and anybody? It's open for anybody. Miroshika? What were the improvements suggested? So Jayasankar? Taraka? If you are here. Okay. Original Basel 1 and Basel 2, we discussed only tier 1 capital and total capital. Okay, tier 1, tier 2, and then finally total capital. But in the Basel 3, the tier 1 capital further divided into two components. Common equity tier 1 capital, we call CET1, common equity tier 1 capital, and the additional tier 1 capital. Okay. So within tier 1, there was a subdivision, and then you have tier 2 and the total capital. So under each element, Basel's, mention what are the, items, capital elements in a bank eligible for common equity tier 1 capital, tier 1 additional tier 1 capital, tier 1 capital, and the tier 2 capital, right? So the common equity tier 1 capital, what were the improvements or what were the requirements brought in? Anyone? Common equity tier 1, what was the minimum standard setup in Basel 3?
4.5%.
4.5%, okay. Then tier 1?
6%.
Okay, total?
8%.
Okay. So basically, the Basel did not change the total requirement. And Basel, what it did was, while keeping the total requirement fixed at 8%, but it divided tier 1 or they enhanced the tier 1 to 6% from original 4%. And within that 6%, they brought in another requirement I just mentioned, what is called the common equity tier 1 capital of 4.5%. That was the main change suggested, the key improvement suggested in the Basel 1. So the common equity tier 1 capital of 4.5%, tier 1 capital of 6%, total capital of 8%. So if you take the two buffers into account at a time, both conservation buffer and the counter-cyclical buffer to the full extent, that is 2.5% extent, is implemented. If it is implemented at a time in a particular country, so what are the capital requirements a bank should have in terms of CET1, Tier 1, and the total? Can someone explain? If both, anyway, the conservation buffer is always there, but if the counter-cyclical buffer is going to be implemented full level, that is 2.5% level, what are the requirements under capital CET1, Tier 1, and total capital a bank should maintain? What are the requirements? CET1?
9.5.
CET1 9.5. Then
Tier 1 11%, and total
yeah.
capital 13%.
Total capital, exactly. So the 9.5 CET1, if both conservation buffer, the conservation buffers are in full force, 9.5 CET1, 11 for the Tier 1, and 13 for the total capital. So that means if you look at the improvements are such a way that it will ensure significantly high amount of capital, of which also high quality capital to maintain any risk. Now, if you look at even CET 9.5 is above the what? Original Basel 1 and 2 total capital, because the total capital was 8%. But now with the buffers, it will go up to CET1 alone go up to 9.5%. So that gives somewhat comfortable level for banks to mitigate any risk arising from any unexpected event. But then other than this improvement and buffers, there's another element brought in under capital, capital improvement. What is that? What is that? Anyone? Another ratio, leverage ratio, remember? So the other element is, because as you know, banks are highly leveraged, so that there should be minimum, it should not go below particular level. So that leverage ratio, that is simple non-risk-weighted capital, that is tier 1 and tier 2 total capital, divided by the assets, that is on and on balance sheet assets, as a not risk sensitive measure, without considering any risk percentages, should be more than or equal or more than 3%. Okay, so that was the other measure brought in under the capital part. So those were the key changes in terms of Basel III. In addition to the liquidity standards we already discussed under the liquidity, that is LCR, liquidity coverage ratio, and the NSFR, net stable funding ratio. So let us go through how the Sri Lankan context our banks follow, but our standards are much more stringent than what the Basel suggested, to ensure our banks are much more comfortable in meeting any risk. So I think all of you can see this. Can you all see the slide moving?
Still not, only this banking act one is in
This one. Now can see?
Now in 59 slide.
Can? I don't know why it's there. Is slide moving or not?
We can see 59 one. So that's after the banking act. So we are only that it's we can't see the moving, but the slide is 59.
That is this one.
these directions shall be applicable to every
Yeah,
LCB
that is
and
the one. That is the one. You can see that, no?
I can see, hope others can see it.
Yeah. If you can't see, please let me know. I hope, because now most of you don't talk. So I will moving. If you don't stop me, because only Oresha is speaking. Others don't speak. So I hope every other can see this. I assume since what Oresha said. If you don't see, please stop me. Otherwise I don't know. Okay. So these directions shall be applicable to every LCB and LSB, that is licensed commercial bank, and LSB incorporated in Sri Lanka on a solo and consolidated basis. That is because in the capital adequacy direction, Basel tell for regulators whatever the capital adequacy requirement should be applicable on an individual basis for the bank, and if bank is within a part of a group, on a consolidated basis as well. So that's why it applies for an individual bank, and if it is part of a group, on a consolidated basis also. Like you prepare financial statement, I think when you prepare the financial statements, you see some in certain institutions, not only banks, if they are part of a group, they prepare the consolidated statements as well. So here also for individual bank and for the consolidated basis. And for the overseas banks, which are the branches operating here, that is on a solo basis. So commencing 1st July 2017, every LCB, LSB shall maintain at all times the relevant ratios and buffers prescribed in Schedule 1. So there are some, this is the original direction. Uresha, can you see this? Minimum capital requirement? Huh?
Still the same slides. The one you
Okay. Okay, now you can see, yeah?
Yes.
Okay, can you see now the?
Yes, sir.
Okay. Okay, let me go to Can you see the new slide? Minimum capital requirements and buffers under Basel.
Can see, sir.
Okay. So so like what we discussed, the international standard, yes, last week and today, just recap. So again, this direction set by the Central Bank of Sri Lanka again discuss about the same level of capital. The capital should consist of tier 1, that is tier 1 common equity tier 1 and the additional tier 1 capital, and tier 2 capital. The capital requirements, so the risk-weighted assets should be maintained as a percentage of, capital should be maintained as a percentage of risk-weighted assets based on the following approaches: standardized approach for credit risk, standardized measurement method for market risk, the basic indicator approach, the standardized approach, or the alternative standardized approach to operation risk. So basically, for the credit risk, they have specified the standardized approach. I think all of you know what is standardized approach. We briefly explain, but we will see how it applies in the direction. Then for the market risk, two methods what we discussed. So we, the IBSL suggests standardized measurement approach. And for the, what you call, operational risk, again, three approaches we discussed. So here, regulators suggest either basic indicator or standardized approach up to the bank, or they have also come up with what is called alternative standardized approach, right? So this is how in Sri Lanka, our banks follow the direction. Okay, is slide moving now? Okay, capital buffers. Now, capital buffers shall be implemented on staggered basis. And so basically, they have detailed how capital buffers should apply. Now, the three areas the direction has suggested: the capital conservation buffers for all licensed banks, okay, capital conservation buffers for all licensed banks, and capital surcharge for domestic systemically important banks.
So excuse me, I can't even see the slide moving. I don't know how others can see.
Okay. I don't know why this comes. Can see, now?
Still in the minimum capital, the previous slide.
Okay.
60.
Can now?
Now, okay.
Okay. Can no?
Yes, sir, can.
Okay. Go back and come here. Something wrong with slide. Can you see now the slide capital buffers?
So nothing can be seen.
Okay. Can see now. Okay, capital buffers? Can see now, no?
Yes, sir.
Okay, capital buffers shall be maintained on staggered basis. There are three areas focus: conservation buffers for all licensed bank, and there's another buffer which is called the capital surcharge for domestic systemically important banks, DSIBs. And counter-cyclical buffers will be implemented as and when excess aggregate credit growth is judged to be associated with a buildup of system-wide risk. So basically, three elements in local context: capital conservation buffer, capital surcharge for DSIBs, and again, counter-cyclical buffer as and when necessary. And when this original direction was issued, it was mentioned it is applied on a staggered basis, but will be fully implemented by 1st January 2019. Now we are in 2020, so now these directions are fully applicable among all the banks.
So this capital conservation buffer is not applicable for development banks, no?
This is for all this direction apply for all commercial banks and specialized banks.
Right, okay, sir. Okay.
So that's what this direction say. Yeah. Okay. These directions shall be applicable to LCBs and LSBs. Okay?
Okay, sir.
So, can you see this slide of table 1?
Yes, sir.
Okay. Now, table 1 sets, now, of course, now, if you look at the final column, now that is the one now we apply. Don't worry about because since this original direction was issued in 2016, so that's why different phases were given. But now if you look at for any bank less than 500 billion, these are the ratios applied. that is minimum CET1 4.5, CCB, that means capital conservation buffer 2.5. So that means CET1 plus CCB comes to 7, and Tier 1 8.5, and the total capital plus CCB comes to 12.5. So that is for smaller banks. I think recently there was a little change. I want to check the recent change. I will probably inform you maybe once I get that one direction. But this is the general, basically the applicable ratios right now for banks less than 500, and now for banks above 500. So there is additional buffer called DSIP buffer. With that, the applicable ratios are CET1 4.5, CCB 2.5, and also surcharge 1.5. So that means CET1 and surcharges all together comes to 8.5. And Tier 1 with surcharges, the conservation buffer and surcharge will go to 10, and the total will be 14 with all these surcharges. Without conservation counter-cyclical buffer, because counter-cyclical buffer will be applied only if that requirements need defective. So you see in Sri Lankan context, the requirements are a little bit stringent than what the Basel has suggested, so that our banks have a greater, greater ability to mitigate any risk arising from all these unexpected and expected risks. Okay. So all banks, I'm not going to read everything. All banks shall report the position of capital adequacy as the last calendar date of each quarter financial year through a web-based system. So there is a web-based return. All I think bankers who are in the compliance or sections, they know what is the web-based return they should submit to the central bank. I'm not going to discuss in further. And with regard to the maintaining capital buffers, there are some guidelines given. And also the objectives are given. If you look at the key features of CCB that have been drawn down during a period of stress shall be rebuilt by way of reducing discretionary distributions of earnings. Discretionary distributions may include dividend payments and share buybacks. Additional capital may be raised from the market to conserve internally generated capital. Future predictions of recovery will not be accepted as justification for maintaining generous distribution when capital buffers are depleted. Now, what it says is basically, now this is a conservation buffer to be used during a period of stress. You see, because your minimum, let's say CET1, your minimum is 4.5. On top of it, you need to maintain conservation buffer of another 2.5. That means 7%. So during a stress period, what happens? Your capital will come down due to this. So this buffer is there so that even the capital comes down, it will not go below 4.5. That is the objective of a buffer, right? Objective of buffer. So it's like, you drive on the road, you keep a certain distance with the front vehicle. So there is minimum, you keep, but you keep certain additional, distance to meet undue stress. Now, for example, unexpectedly, the vehicle coming behind you, knock your vehicle, suddenly your vehicle will go further, push the further vehicle, and then it may, hit on the front vehicle. So if you have additional buffer, at least you can maintain that distance fairly comfortably. Okay. So similarly, so this buffer ensure, okay, whenever capital comes down due to stress at a stress period, you can still maintain the minimum CET1. So buffer will erode. The buffer will erode. So in the meantime, whenever buffer erode, also Basel suggests, okay, then if your buffer erode below 7% up to this particular level, different levels, you must conserve the capital to build up the buffer again, right? So let's say now you are maintaining 7% capital CET1. Let's say your bank is maintaining a CET1 of 7.5. Your bank maintains CET1 of 7.5. So what does it mean? So what does it mean? If your bank has CET1 of 7.5, what does it mean?
Fully compliant.
You are fully compliant because the minimum is CET1 4.5% plus buffer 2.5, minimum requirement is 7. Now, let's say sudden unexpected risk or stress event the bank face, and bank capital will come down to 6.5. What happens then? Suddenly, bank will come down to 6.5. So what happened?
Conservation buffer has gone down.
Yeah. So you comply with the CET1 minimum, that is 4.5, but you are not complying with the buffer requirement. So buffer requirement is 7%, but now including the buffer, your capital is 6.5. So that means you are not at a non-compliant level, but in terms of risk, you are okay because still you are within the CET1. Okay. So then what it says is whenever you meet a stress event and the capital falls below 7%, you have to conserve the capital like this way. Now, let's say in the example I took, now our ratio is 6.5. So that means you have to conserve 40% of your earnings thereafter until you build the capital to minimum 7% level. Conserve means you are subject to certain restrictions of your earnings, right? So that means now in the example I just gave, the CET1 capital ratio buffer has come down to 6.5. That means 40% of your earnings you must conserve. That means you can distribute only 60% of your earnings until you, meet 7% requirement. So once you reach 7% requirement, you can start distributing earnings, right? So this is what the requirements say. Now, for example, let's say your capital, total capital comes to 5.6%. Then what does it mean? Not total. CET1 come to 5.6%. So what does it mean?
Out of the earnings, 80% has to be retained in the bank itself. Only 20%
Exactly.
is the bank.
So out of the earnings, you need to retain 80%. Why you need to retain 80%? To build up the CET1 up to 7%. You can distribute only 20% of your earnings. So that is the restriction, right? Okay. Then similarly, for the total capital, so these are the requirement when total capital go below the 12.5. This is for especially for smaller banks, like it's go below 12.5. Then these are the conservation requirements, and your earnings are subject to some restrictions. Now, what are the restrictions? Elements subject to the restriction on distributions. So basically, whenever your capital comes below either CET1 comes below the 7% or the total capital comes below 12.5%. These are the restrictions. You can't pay cash dividend. So cash dividends are subject to the limits. Now, in this case, if your ratio is like 4.7, you cannot pay anything at all. Now, if your ratio is 5.6, you can only pay 20%. Okay. So these are the share buybacks. You can't do these things. You can do only subject to that limit. Payments which do not result in depletion, CET1 capital, are not considered as distributions. Okay. So anything not result in depletion of CET1, exempted, but cash dividend, share buybacks, anything which is not other than not resulting CET1, subject to this restriction. Now, definition of own is also given. Distributable profits before deduction of elements subject to restriction on distribution mentioned 1. Okay. So any profits before reduction of these elements. So that's how the discipline is brought among the banks. Okay. Then I will move on to the surcharge. Now again, if you look at surcharge, apply for DSIPs. Now I think there's a small change. I will let you know probably next time about this 500 billion requirement. But for what is identified at DSIPs, there's an additional surcharge of 1.5% applicable, right? So if a bank fails to meet the capital surcharge on DSIP during the transitional period, that is during that original period, now it's now no longer it apply, the licensed bank shall adhere to time frame for meeting the requirement by imposing restriction on discretionary distributions. So that is of course at that time, but now no longer it is applied. So I'm not going to discuss in detail. So when this brought in 2016, when a bank is not able to meet this, so there were, certain restrictions. But now, since we are in full implementation, everybody has to follow the requirements mentioned in the third column, which are applicable from 1st of January 2019, right? Now again, the direction sets the framework for supervisory review process. Remember, we discussed last week in detail what Basel specified, and this direction issued by the Central Bank of Sri Lanka also clearly specified what it applies. Okay. Okay. So again, direction has set the objectives for SRB. The objectives encourage banks to utilize better risk management techniques, the level of risk a bank is exposed to, and the control environment that will determine the level of capital required to be maintained by banks, and enhance the risk-based supervision of banks in order to assess the capital adequacy relative to banks, and also evaluate the ICAP that determine the level of capital to be maintained against the risk. Okay. And also ensure that banks use ICAP in more general business decisions and budgets in more specific decisions such as allocating capital. Okay. So again, if you look at direction, specify the similar, or the almost same principles that or the Basel International Standards set about 4 principles we discussed. So I'm not going to discuss in detail. So this is almost same as what we discussed last week. But here it's clearly said the Central Bank of Sri Lanka will intervene. Then, okay, let's move on to the third pillar. So the third pillar, which we didn't discuss in detail last time, but here the direction itself set the framework for pillar 3, that is market discipline. Okay, pillar 3 aims to complement the minimum capital requirements and supervisory review process by developing a set of disclosure requirements which will allow the market participants to gauge the capital adequacy and risk exposures of licensed banks. Okay. And these requirements will improve the comparability and consistency of disclosures among licensed banks and facilitate assessment of the bank by others, including investors, analysts, customers, other banks, and rating agencies, which leads to good corporate governance. So the disclosures under these requirements broadly include the regulatory capital requirements and liquidity risk, liquidity, risk-weighted assets, linkages between financial statements and regulatory exposures, risk management, and a discussion on adequacy meeting current and future capital requirements. So basically, as I mentioned, the idea of Pillar 3 is to give a broad understanding about the capital adequacy and the risk exposures of licensed bank to the stakeholders, including investors, analysts, customers, rating agencies. The important thing is this facilitate the comparability and consistency. Because when all the banks need to follow standardized disclosures, it will give more, consistency and comparability. Because now let's say an investor looking at investing in a bank, when they see this published, information among different banks, they can come to a right decision because they can compare, because it's standard, and also it is transparent. So that's give added advantage in rational decision making. So that is the sole objective of this particular pillar. Okay. Now here in our context, now these are the requirements. In summary, this is a detailed report is there, but in summary, the requirements are for the capital and liquidity. There are 5 elements I have highlighted. You need to disclose the key regulatory ratios, capital and liquidity. And also, if you look at the last column, it states how often you should disclose and how the methodology you should disclose. Now, P stands for press, W stands for your web, A stands for annual report, right? You see in the last column, 2 columns, you see P, W, and A appear. So now if you look at the key regulatory ratios of capital adequacy and liquidity, you must publish to the market quarterly in the press and in your web, but annually in the press, annual report, and the web. So that is the standardized requirement. So the all banks, if you take capital and liquidity ratios, must be disclosed to the public both quarterly and annually. But quarterly, it is in the press and web, but annually, it is in the press, web, and also annual report. So in terms of regulatory capital and liquidity requirement, there are 5 elements. Now, element 2 is about computation. You must disclose how did you compute capital, how did you compute leverage ratio, how did you compute liquidity coverage ratio, and also main features of regulatory capital instruments. So the stakeholders, the public can, if they really want to do assessment, that will give a clear picture of risks and the capital. Then about the risk-weighted asset, you see the major disclosures items 6, 7, 8, 9. So some of them are quarterly, some of them are both quarterly and some of them are only annually, but some of them are both quarterly and annually. Okay. And if you go further beyond, you are also supposed to indicate the linkages between financial statement and regulatory exposures. Now, under that, if I little bit go through, item number 11, difference between accounting and regulatory scopes and mapping of financial statement categories with regulatory risk categories. Now, what does it mean? Linkages between financial statements and regulatory exposures. Now, if you look at financial statements, now they follow international accounting standards. But in case of certain risk directions, The regulators say, okay, you need to, now the classic example is credit risk. Now for credit risk, what the regulator specify? Can someone tell? There are specific directions about credit risk the regulators mention. What is that? Can someone tell? Come on, quickly. Specific area directions. I don't want the numbers, but specific requirement with respect to credit risk. Regulators specify. Anyone? Bankers? I think there should be an adequate dialogue in this regard because all of you are working in the bank, especially in the credit area, most of you. Can someone tell? Uresha?
So under the standardized approach, as per the same criteria, but if you go by the accounting standard, we do have another approach by categorizing the assets.
Little bit detail. Credit risk, what are the specific, I'm not asking numbers, specific areas that the regulator tells about the,
The 8 business lines which are given by the standardized approach.
no, that is for the operational risk. 8 business lines for the operational risk. Credit risk. The provisioning requirements. Remember? The directions specify how banks should make provisions based on the NPLs. So the directions specify how you should classify particular facility advance as NPL and the corresponding provisioning, right? But if you look at accounting standards, when they prepare the financial statement, they follow international accounting standards set by the, if you look at Sri Lankan context, the Chartered Institute. So in today's context, what are the accounting standards you follow? When you prepare the financial statement?
It's IFRS.
Yeah, IFRS, but what
It's
is it?
impairment
The concept? Yeah, impairment on fair value basis.
Special mention substandard loss and outcome.
Yeah, so that is basically international accounting SLFRS 9 or IFRS 9 say this is how you should value your assets, fair value accounting. Okay, so for what you call trading assets, what you call assets held for sale, and then what you call long-term assets held to maturity. So basically, when you prepare the financial statement, you follow that. But that may not be exactly with the regulators. So there may be slight difference between the regulators' own and the accounting standard studies. So that's why this part of disclosures, because when somebody look at financial statement that is prepared in terms of accounting standard, may not exactly, like the what you call banks follow in terms of regulations. So those linkages, if there are any differences, those linkages must be clearly disclosed to the market participants. And also, if you look at item 12, explanations of difference between accounting and regulatory exposures. So the people know, okay, this is standard, this is regulatory requirement, so this is a linkage. And also about the risk management process, basically annually in the annual report and the website, right? So these disclosures will give comfort to the all stakeholders or the outside parties about the different risks, capital and risk are covered, what further methods adopted, how these numbers calculated, and the linkages between regulatory capital and the financial statements prepared as per the accounting standard, and the broader risk management process. So no one can blame later on. because you can take a rational decision by looking at these numbers. More transparent. Now, today in Sri Lankan context, all people know about, they don't look at risk, they just pump money anywhere, and something goes wrong, they blame the regulator. Why should we? Okay, now when you are driving on the road, there's a clear sign stating there's a very narrow bend or whatever, and it's a high risk area. So the signal, whatever the symbol or signal or the board is, to ensure in next 500 meters you come to this one. So it is up to you to decide. When you see that sign, you should not move as a fool, reckless person. So signal says, okay, whenever a school is there, they say that okay, there's a school, the children crossing, and you must slow the vehicle. You see. So without following that, you go and hit whatever and then come to a problem, and you can't blame anybody. So you have to blame yourself. So that is the discipline brought among the both parties. That is for the banks. Okay, disclose. So people will have understanding. For the stakeholders, okay, banks have disclosed. Now you take a rational decision. Don't do any irrational decision and blame it. Always in countries like Sri Lanka, it's a blame game. You take the wrong decision when the information is adequately there, and then blame the regulator. That's in Sri Lanka. So the overall in Basel context, so this is how they want to bring market discipline. So everybody need to do their job. Bankers need to provide information, transparent way, consistency, comparability. The rational decision makers, analysts, investors, depositors, whoever need to make rational decisions on the other side. So that is the pillar 3 requirements in terms of direction. Okay. Any questions so far? Okay, no. Then let me remember when we start the Basel, original direction, I said I will explain about these different elements later. So I think it is a good time you go straight away to the direction presently applicable. Now, if you look at this slide, this third part of direction I have extracted. There may be latest slight changes, but to give a broad understanding. So the directions part 2 is specified. What are the elements eligible under the, if I can little bit, can you all see this? Computation of total capital?
Yes, sir, but not in the presentation.
Huh?
Not in the big size, but can see.
Okay, but okay, at least you can see. So then what are the elements under common equity tier 1 capital? So the common equity tier 1 capital after adjustments. So equity capital, I'm not going to discuss each and everything, but to state briefly. So equity capital or stated capital or assigned capital, reserve fund, published retained earnings, accumulated other comprehensive income, general and other disclosed reserves, unpublished current year profits or losses, and gains reflected in other comprehensive income, ordinary shares issued by consolidated banking and financial subsidiaries of the bank and held by third parties. If you want to get further details, better you read the direction. But then bank know these are the elements I can take into my common equity tier 1 capital, right? Clearly specified. So bank knows, okay, these are the elements I can take into common equity tier 1 capital, right? And also, remember I said that earlier in the Basel 1 and 2, certain adjustments need to be made. Most of the adjustments are made in after the tier 1 and tier 2 before arriving at the total capital. But in this particular Basel 3, you have to do most of the adjustments in the common equity tier 1. again, so those adjustments are highlighted here. Now, if you look at the total adjustments to the CET1 capital, goodwill, other net intangible asset, revaluation losses of property, plant and equipment, deferred tax assets, cash flow hedges. So there are a number of, in this particular course, we are not going to discuss all this technical stuff. There are many courses explaining this computation, so you can follow them. But I want to highlight this. The adjustments are also highlighted in the direction, right? Can you see this? The next slide? No? Okay, can you see the next slide?
Yes, sir.
Okay, not in the full version, no?
Yes, sir.
Okay, so basically, the next slide is about, let me see whether I can take the full version. Okay, if you look at middle of it, you will see additional tier 1 capital. Can you see the additional tier 1 capital? Under line item 20.2.
Yes, sir.
Okay, so if you look at additional tier 1 capital, it says what are the elements qualifying additional tier 1 capital instruments. Investments issued by consolidated banking and financial subsidiaries of the bank and held by third parties. And so it again specifies what are the elements, the capital elements eligible for additional tier 1 capital, and also certain adjustments it has suggested. Right.
So this tier 1 is 8.5. So out of that, what is this additional tier 1 percentage?
There is no additional tier 1 capital. Out of tier 1, tier 1 should be 6%, of which 4.5% should be common equity tier 1. Okay. So rest of the, tier 1 could be take the form of additional tier 1. So there is no like percentage. You must maintain total tier 1 of 6%, of which at common equity tier 1 should be 4.5.
Right.
Okay. So there is no percentage for additional tier 1, right? Can you see the next slide?
Yes, sir.
Okay, let me go to the previous slide. Okay, now again, if you look at the tier 2 also, it is defined what is tier 2 and also what are the eligible items. And then when you take, and also the adjustments. So when you take common equity tier 1, the additional tier 1 and tier 2 after adjustments, you will arrive at the total capital. If you look at the last line item says total capital. So that's how you get different capital elements. So direction has clearly stated these are the items eligible. These are the items you need to deduct, right? Okay, then we'll look at the risk-weighted assets for computation for risk-weighted assets. Now for the credit risk, again, credit risk, the direction has specified different risk weight for different assets and different risk weight for different assets based on the credit rating. Remember? The Basel 2, there are two ways we can do the standardized approach. Remember, we said in Sri Lanka, we follow the standardized approach to credit risk. And what is the other approach? For credit risk? What is the other approach for the credit risk? Standardized and what we discussed last time.
IRB.
Okay,
IRB.
internal rating based approach. Again, divided into two. What are those? Yeah, IRB, there are two, exactly. So IRB, foundation and advance. But most, I mean, if you look at international banks, they follow because they have sophisticated models which you can easily capture, right? But here we follow the standardized approach. This is basically based on more or less, most of the assets are based on their internal ratings. So I will give a little, I will explain it a little bit. Now, if you look at total risk-weighted asset for credit risk under the standardized approach, all the assets are categorized into different asset classes. Now, if you look at the first one is the claims on central government and Central Bank of Sri Lanka. Okay. The claims on central government and Central Bank of Sri Lanka. Under that, there are three elements: central government and rupee claims on central government. Central government and rupee claims on central government. So basically, risk weight is 0%. So that means any exposure to central government in terms of rupee claims, what is the capital you need to maintain? What is the capital you need to maintain? Huh? Come on. What is the capital? Capital, how much capital you need to maintain as per the schedule?
There's no need to maintain any capital.
Yeah, there is no need because risk-weighted asset percentage is 0. That means credit risk is 0. Isn't it? Credit risk is 0. Credit risk is 0 means risk-weighted asset is 0. Because the risk, how do you get the risk-weighted asset is the exposure multiplied by the risk weight. So exposure, let's say 500 million. 0 into 500 million is 0, on which you need to maintain the relevant capital 0. Okay. So similarly, foreign claims 20% of central government and Central Bank of Sri Lanka 0%. So likewise, for each asset class, the Basel specify either based on the risk rating or otherwise, what is the risk weight applied. So that in Sri Lankan context, these are the applications. Now, if you look at claims on foreign sovereigns and central bank, if there is any claim by the bank on exposure by the bank on a foreign government or foreign central bank, so the credit risk weight based on the rating. So if it is, if that particular government is a AAA to AA minus, the risk weight apply is 0. A plus to A minus, risk weight apply is 20, and so on. So let me ask a question. Now let's say bank, ABC Bank in Sri Lanka has an exposure to a overseas central bank. Let's say overseas government in particular country having a rating of A, having a rating of A, amounting to 100 million. Let's say 500 million. 500 million. So the exposure of ABC Bank in Sri Lanka for government X, that is overseas government X, is 500 million. Okay, so that is a foreign sovereign. Overseas government is a foreign sovereign, foreign country. 500 million. The rating of that foreign government country is A. How much common equity tier 1 capital bank should keep for that exposure? How much minimum tier 1 capital should keep for that exposure? Okay, minimum tier 1 capital. Okay, how much minimum total capital you should keep? Okay, forget about what you call okay, I'll say I am not going to the limit set in this direction, but let's say the requirements are 4.5 tier 1 common equity tier 1, 6% tier 1, and the what you call total 8%, so which is not the Sri Lankan one, but let's say for the time being for this particular question, so you need to maintain this particular bank, ABC Bank, need to maintain CET1 of 4.5%, tier 1 of 6%, and total of 8%. So how much capital bank should keep for this exposure as per this guideline? 500 million exposure to a country which has the overseas government which has a rating A. Can someone tell? Okay. How much capital that particular bank should set aside for credit risk? For CET1, tier 1, and total, if the relevant ratios are 4.5%, 6%, and 8%. Horesha?
Sorry, sir. I think due to network error, I lost your question, so I'm not sure what to do.
Sorry?
So I lost your question because I couldn't hear your question. So I think network.
Okay. Okay, a bank, okay, has exposure to overseas government. The rating of that overseas government is A. Okay, A. Okay. Rating of that overseas government A. How much capital that bank should keep for that particular 500 million exposure to that particular overseas government for the credit risk, okay, for CET1 capital in terms of CET1, Tier 1 and total if the applicable ratios are 4.5%, 6% and 8% as per this schedule. So this schedule says for claims on foreign sovereigns and central bank, for different rates, these are the risk-weighted assets. So that is a pretty simple.
20%?
So I am at the quantum of capital.
Okay.
Quantum of capital for that exposure. Anybody else? I mean, it's open for all. How much capital? I mean, just take a couple of minutes. CET1, Tier 1 and total. If the applicable ratios are 4.5%, 6% and 8%.
So is that 6 divided by 0.2?
6 divided by?
0.2? Is that the way we have to do it?
Oh, okay. How do you do it? Because I explained earlier also, capital is based on the risk-weighted asset. Okay. For CET1, you need to maintain 4.5% common equity Tier 1 capital of risk-weighted asset for total capital, Tier 1 6% and total 8%. Now, how much the risk-weighted asset in this particular case? What is your exposure value? How much your total?
20%?
Yeah, I'm asking how much value?
100 million?
I'm asking, How much? Your total exposure is 500. Risk weight applicable since it is a A rating, the credit risk is 20%. If you look at this chart, for a overseas, Okay, let me explain. So 500 million into 20% is the risk-weighted assets. How much? 100 million. Right? 100 million is the risk-weighted assets. And we need to maintain how much common equity Tier 1 capital? 4.5%. 4.5 million. How much Tier 1 capital we need to maintain? 6%, 6 million. How much total capital we need to maintain? 8%, 8 million. See? So that is the capital we need to maintain. Okay. If a loan of 500 million is in your books for such a sovereign, so that's a pretty straightforward example.
100 million.
So you should be able to, this is how the banks are computing. Sorry. The 100 million is the risk-weighted assets value. Then you have to compute the capital. So the capital for CET1 is 4.5 million. Capital for Tier 1 is 6 million. Capital for total is 8 million, right? Very simple. Now, what I want to give example is how do you compute it, okay? So similarly for all the other assets, if you look at claims on public sector entities, it specifies these are the ratios applied, so you can compute the risk-weighted assets and then the capital. Okay, so I'm not going to discuss each and everything, but for each asset class in your balance sheet, the standardized approach specify the applicable risk-weighted asset percentage, either based on ratings or otherwise. Okay. Claims on financial institutions, claim also on financial institutions regulated by the central bank, and so on. Okay, then again, other important thing is now, if you look at this particular table, it gives now, remember, when you compute the capital for credit risk, it not just for the on-balance sheet. You need to compute capital for the off-balance sheets as well. Now, you know, off-balance sheet items such as direct credit substitutes, then short-term liquidating trade-related contingencies such as shipping guarantees, documentary letter of credits. So there are a lot of items. I'm not going to discuss each one. But in the case of off-balance sheet items, there's a two-way process. Now, first you have to convert the off-balance sheet item into an on-balance sheet item. How do you do it? You can use the credit conversion factor. If you look at here, you have been given the credit conversion factor, right? Credit conversion factor. So then you first convert the off-balance sheet item into a on-balance sheet item, then apply the relevant credit risk factor as we discussed earlier, right? So it's a two-way process. Okay. And also, if there are risk mitigation, you can apply that as well for different exposures, you know, what you call retail exposures, the cash, government securities, provident fund balances. If your exposure is covered by, you know, these risk mitigants, then you can apply appropriately for the relevant principal amount, right? Okay, then the direction suggests how you compute the risk weight for the market risk. Again, market risk, we follow standardized approach. So there it says, it sets based on the general and specific risk for different market risk element. Now specify what is the capital charge for the general interest rate risk and the specific interest rate risk. There's a computation methodology given. Since this is more technical, I'm not going to discuss each and everything. Then again for equity, what is the general equity risk? What is the specific equity risk? Okay. Then capital charge for foreign exchange and the goal, how you are going to compute. So then you can arrive at the total risk-weighted amount for market risk. Then similarly for the operational risk, remember the Sri Lanka, we have allowed standardized approach, basic indicator approach, standardized approach, and alternative standardized approach. Under each approach, how you should compute the risk-weighted asset. If you look at this particular table, so the basic indicator approach, it's simple, 15% across the board for last 3-year gross income and the capital charge. Then if you have the standardized approach under different business line, what are the capital charge factors ranging from 18, 12, and 15, okay? Then the alternative standardized approach, again, what are the different, the risk factors 18, 15, and 12 as given in the particular chart, okay? And also there is a fixed factor 0.035 for retail banking and commercial banking under the alternative standardized approach, right? And then you can compute the capital charge for operational risk. right? So again, how do you compute the gross operational income for the basic indicator approach and standardized approach? It is given the different business line. How do you compute? So I'm not going to discuss all this in detail. So basically, the computation methodology is clearly given so that you can compute the capital charge for overall risk-weighted assets for credit, market, and liquidity. So the formula is given, the methodology is given, so the bankers can calculate without any difficulty how do you, the particular ratios for CET1, Tier 1, and the total under this particular guideline. Okay. Any questions? Any questions? No? Okay. So we will move to the probably the last area of this particular program. Okay.
So on this core capital, is it the tier 1 capital that in this what you call classifications is that we have to take? That when we are
But
computing core capital, because this core
yeah,
capital.
core capital means the Tier 1.
Tier 1, okay.
Yeah, core capital, the same meaning Tier 1. Within core capital, you have common equity Tier 1 capital, which is 4.5%. When you say Tier 1 or core capital, same. So basically, core capital is 6%, of which 4.5% to be in the form of common equity Tier 1 capital. Then total capital is 8%. That is in the international context. But in Sri Lankan context, we just now discussed based on the asset size, it will differ, right? We just discussed the numbers in the case of Sri Lankan banks, that is LCBs and LSB. So that it's not 4.5, 6, and 8. That is international. But here, our context totally different. I think you saw the numbers. Even it's going up to 14% total.
So one more thing, other than this capital, this conservative buffer and this general buffer, in Sri Lankan context, there's no additional buffers requested as per the bank's performances?
No, we have DC. From conservation and domestically, systemically important bank, there's a DC buffer.
Right. So that's why the tier 1 and the total ratios are different in the annual reports from
Yeah, we have a DC. Remember, I showed you a chart. If you want, I can go back again. If you look at can you see this slide?
Yes, sir.
Yeah, so you see here the minimum CET1, CCB, and DSIP charge for the large banks, and so the ratio is different.
Right, right.
If you look at a small bank, you don't have DC, right? It's different. But if you want to know about in detail, I think there's a direction, this particular direction, and there were some recent changes. But then if you go through, it gives a clear picture about how you are going to compute. So you have a very detailed understanding. But and also, if you want to know exactly calculation, there are more courses on calculation part. You can join one of those programs at our Center for Banking Studies conducted. Resource persons are from our supervision department. So they will explain in detail how these computations are done. So then you have a great understanding. But here I just brought in the concepts because the purpose of this course is not to go to the computations in detail, but how the different risks are captured in terms of capital adequacy framework. Okay, so that was the objective for this course. So you should have basic understanding how different risks are captured under Basel 1, 2, and 3, and what critical components introduced under different regimes, but not really the computation. I will not ask if there are any questions, no questions on computations, but the concept. So you must have a better understanding of the concepts. Okay. Any more questions? Can you see the presentation? Corporate governance and risk management?
Yes, sir.
Okay. So basically, we will move on to the the last area of my part, corporate governance and risk management, the linkage. So let me give a brief overview. Then probably we will have a short break, and then we will continue for the rest of the day. So basically, what I am trying to go through is the corporate governance. What do you mean by corporate governance? And what is risk management and how they intersect. Whenever we talk about corporate governance, we talk about risk. Whenever we talk about risk, we talk about corporate governance. So these are interlinked, interrelated components. So no bank can exist without corporate governance, then it will lead to risk management. If your bank does not have improper risk management, does not have proper risk management, it's the issue of corporate governance. So why is risk governance? So ultimately we can combine two and tell risk governance important. And what is consequence of failure? How do we respond to them or what we do? So that is basic overview of this particular session today. In general, what do you mean by corporate governance? It's a term that refers broadly to the rules, processes, or laws by which businesses are operated, regulated, and controlled. So when you take corporate governance, we refer to set of rules, processes, laws by which business are operated, regulated, and controlled. But it is beyond that. It is beyond that. A well-defined and enforced corporate governance provides a structure that works for the benefit of all stakeholders by ensuring that the enterprise adheres to accepted ethical standards and best practices as well as to formal laws. Okay. A well-defined, enforced corporate governance provides a structure that works for the benefit of all stakeholders. So when we work corporate governance, we think it's only for the us, that means the institution, but not for that benefit all stakeholders. By ensuring that enterprise adheres to accepted ethical standards and best practices as well as formal. So it is going beyond formal laws, ethical standards and best practices. That there are a number of definitions. Many organizations have come up with different definitions for governance, but I have just highlighted one such definitions by the OECD countries in April 1999, the system by which business corporations are directed and controlled. So it is a system by which the business corporations are, directed and controlled. This specifies the distribution of rights and responsibilities among different participants in the corporation, such as board, managers, shareholders, and other stakeholders. So it sets rights and responsibilities among different parties, internally as well as externally. Spells out rules and procedures for making decisions on corporate governance. So it's sort of a broader rules and procedures setting framework. Provides the structure through which company objectives are set and the means of attaining those objectives and monitoring performance. So it's a broader definition of corporate governance. So, but despite whatever definition any organization sets as corporate governance, but in simple terms, in practical terms, you can simply say governance is corporate governance, doing the right things and doing the things right. Two things. Doing the right things and doing the things right. In other words, doing the right things for the organization and doing things right way independent of personal interest. So there is no personal interest in a governance, well-governed framework. You have to keep your personal interest set aside and do the right things for the organization and also do the things in the right way. Also say it is the processes and systems by which a company is governed with appropriate checks and balances. So there are set processes and systems which companies govern, but which should ensure appropriate checks and balances. So checks and balances are always there so that there won't be any undue, problems in the, or create undue disturbance to entity or the market. So essence, it is to ensure good performance of the organization, proper accountability to all stakeholders. So accountability, another important word when you talk about governance, important word is responsibility, accountability, and conflict of interest. So whenever something happens, there should be accountability, which is one of the, in our systems, which many people don't understand. No one is accountable. You see, anywhere, in not only organization, who is accountable? If something goes wrong, everybody pass the blame to other. So this should not be the governance way. Governance is proper account. So in institutions, especially the banks, it's very important accountability. You are playing with the depositors' money. So you have a great accountability. If something goes wrong, you must tell what happened, why, who is responsible. You can't simply wash your hands. Then mitigation of conflict of interest. You should not you must not use internal, whatever benefits for your own interest, internal, situation for your own interest. You must act without conflict of interest. So that is the governance. So the stakeholders, as I said, include customers, staff, shareholders, suppliers, regulated companies. So it covers broader group, both internally and externally. So if you look at a broad structure framework, start from the shareholder, because shareholders are owners who put the equity into the business, but they may not get involved in the operations. So shareholders simply put the money and wait and see to get a good return. Then there are board of directors appointed either by the shareholders through other means, to run the business on their behalf, to safeguard their money while safeguarding the interest of other stakeholders and who set the business policies. Then below board of directors, maybe whoever is called chief officer, chief executive officer, MDO, whoever they run the organization internally, because board of directors are not involved in the day-to-day operations of your entity. So the board includes a management team led by the MD, executive directors who manage the business. Executive directors are also directors who are engaged in the business operations. On a day-to-day basis, they design appropriate strategies to implement agreed policies. Okay. So there may be other senior management who carry out the operation level functions, marketing, product development, support, whatever you call, finance, and so on. So this is broadly overall structure of organization, starting from shareholders who puts money, then appoint board of directors who take policy decision, then you have the topmost position, MD or CEO, under with him that there may be other executive directors, then there are other senior management. Now, what are the key elements or pillars of corporate governance? The fairness. So that is one of the key. You have to be fair in running your business, in governing your business, or conducting operations. Must be very fair. It's a very fundamentally important concept. Accountability, as I've already mentioned, you must be accountable for what you do. You can't simply wash your hands. You can pass the blame to any other person. So whatever the things you do, you must be accountable. Independent. You must adopt independence and transparent. What of the operations should be transparent. You must be able to tell your judgment or make your comments independently, whatever others say. All processes should be transparent, so no one can find fault with anybody, anything. It should be a transparent process. The major elements of corporate governance, the board commitment, because the board is the topmost, part of the any organization who take all policy decisions. Okay, so they must have a greater commitment for the government. So they must follow the governance principle. They must design it. They must ask others to follow it. Good board practices. So they should, as I mentioned, they should follow good practices in the board. Functional and effective control environment. Okay. So within the organization, there should be effective and functional and effective control. There are adequate controls in place. Transparent disclosures. So always the disclosure should be transparent. Everybody can see, everybody can discuss. And well-defined shareholder rights. The shareholder rights should be well-defined. Okay. Then let's move to risk management. So what is risk management? Is the definition, assessment, risk management is the identification, assessment and prioritization of risk. We already discussed it. There's 8 principles, structure of risk management. I think all of you can remember at the beginning of this particular course, we discussed all these 8 elements of a risk management framework. So it is defined in ISO 31000 as the effect of uncertainty on objectives, whether positive or negativity, followed by coordinated and economical application of resources to minimize, monitor, and control the probability and or impact of unfortunate events, or to maximize the realization of opportunities. So, effect of uncertainty on objectives followed by coordinated and economical application of resources to minimize, monitor, and control the probability and no impact of unfortunate events, or to maximize the realization of it. So it should be either to mitigate any risk or to use, the risk to maximize the opportunities. As you identify the risk, you can maximize the opportunities as well. Okay, so we'll stop there for a 10:30 for a short break for about 15 to 20 minutes. We'll come back and continue the rest of the session. Any more questions before we break for the tea? Okay, so we'll stop for a break, then we'll come again within 15 to 20 minutes. Thank you. focus on achieving growth and profitability within appropriate risk control boundaries. So, question of growth and the profitability within the appropriate risk and control boundaries. So, it's a risk return trade off. Now, on one side, you have risk, on the other side, you have return. Okay. Now, the group's risk function. Give me a minute, please. Okay, the group's risk function, if you are part of a group, is to probe, analyze, mitigate, and accept risk within agreed appetite and the boundaries. Then on the return side, customer needs and financial objectives. Okay, so it is a mix of risk and return, and together is depend on the culture you adopt in your organization. It is the corporate governance, monitoring and effective controls using a macro view of institution built around a shared cultural approach. Okay, so needs of both parties. Okay, so let's discuss few examples of a failure. Now, I have given this slide to explain in different, regions across the world, in different countries, during different times, the failures that has taken place and cost to the financial sector and to the overall economies. Now, if you look at high-income countries like Japan, Korea, United States, and during 90s and 80s, if you look at these countries have faced certain crises. Okay, now take example of Japan in 92 to 98, almost went into 7 years. Non-performing loans went up to 35%. Bank credit to GDP 119.5%. Fiscal and quasi-fiscal cost, that is the impact on cost on the government, 8% of GDP. And was there a currency crisis? There was no currency crisis. But if you look at Korea in 1997, NPLs went up to 30 to 40%. Cost to the GDP is 34%, significantly high. And output loss is 50.1%. And currency crisis as well. But I'm not going to discuss each and every one, but Argentina, Bulgaria, Egypt, Ghana, Guinea, Indonesia, Malaysia, Mexico, Thailand, Uruguay, Venezuela. So it covers almost everywhere in the world. When crisis happen, what is the cost to the overall economy? And also in many cases, it has led to the currency crisis as well. If you look at last 3 cases, Thailand, Uruguay, Venezuela, that has almost led to a currency crisis. So this is the significance of a failure of a financial institution or any other institution. Okay, lead to the economy. Now, classic examples of significant governance failures: the Enron, the WorldCom, the Barings Bank, Society General, Lehman Brothers, JP Morgan, Barclays Bank, Royal Bank of Scotland, AMCON in Nigeria. Okay, which probably you have heard about them, or you have learned, you have read about those. So which we are not going to discuss in detail. But if you look at the ultimate root causes of these many failures, at the poor governance and the poor risk management. So that's why it is very important these two concepts are very important for any institution to ensure its stability and also safeguard interest of all stakeholders. So let's look at few examples. Enron. I think it's one of the famous cases around the world, Enron. I think all of you know Enron. So became bankrupt in December 2001. And look at, it is one of the global leading power, energy and utilities companies. Leading global company. But went into bankruptcy, you see. So now, if someone talks about a leading Sri Lankan company and tells, this can be bankrupt, no one believes. So Enron was such a large company, leading, and 20,000 staff employed and A-rated. Don't forget, it was an A-rated company. And was one of the Fortune's top 100 companies to work for in America in 2000. You see? So the ranking was A. It's not a poor rating. And top 100 Fortune, world Fortune companies in 2000. But failed. What is the reason? The governance, risk management. Creative accounting. Chairman Ken Lay, CEO Jeff Skilling, CFO Andrew Pesto, place liabilities in shell companies not appearing in books. Second, fraudulent deals, which even the auditors, Arthur Andersen, could not find. So which itself led to demise of Arthur Andersen. As a result, US government came up with a new law called Sarbanes-Oxley Act. So which is Public Company Accounting and Investor Protection Act, Public Company Accounting and Investor Protection Act, and also corporate governance rules, new rules, responsibility of directors, and also bring in some criminal penalties. So if you go through, I am not going to discuss the detail, if you go through the Enron case, classic example of significant failure of corporate governance and the risk management and controls. So in year 2000, if someone comes and tells Enron will fail by 2001, everybody will laugh at him. Let's say in 2000, somewhere in 2000, some of the people, analysts talk about and tell, okay, I will fail due to whatever reasons, Enron will fail. No one will believe. A-rated company, top 100, global power energy. How can it happen? But it happened. It happened. The question is not just the rating today, but inside what is happening. Yeah, no one can detect. It's only the internal people who govern the entity must know, and they should not engage in poor governance practices, cultures, and poor risk management. Then WorldCom was America's second largest long-distance phone company after the largest one, AT&T. CEO was one Bernard Ebbers, CFO Scott Sullivan, Comptroller David Myers. So what was the problem? Aggressive growth strategy. Tried to merge with Sprint in 2000, but not approved by the regulators. Fraudulent financial records from mid-1999 to 2002. Booking interconnectivity costs as capital instead of expenses, and as a result, inflating the revenues and the profit. So the internal auditors found $3.8 billion worth fraud. Internal auditors. So the company became bankrupt in July 2002. So the second largest long distance phone company. You see, it's again a governance failure. And probably not problem, definitely the risk management failed. Lehman Brothers, I think, is a famous financial institution which failed as a result of crisis in 2007-9. Founded in 1850, the fourth largest investment bank in US. I think that time, whenever somebody tells Lehman Brothers, everybody know what is it, right? So it is just after Goldman Sachs, Morgan Stanley, and Merrill Lynch, the leading investment banks, but declared bankruptcy in September 2008. Following large exodus of clients, drastic losses in stock, and downgrade of assets by credit rating agencies. And it is one of the largest bankruptcies in US history. Holdings shared between Barclays in North America and Nomura, Asia Pacific, Europe, and Middle East. And also financial accounting gimmicks. I think in many institutions, the people who prepare financial statements, if you have the wrong person, they can make gimmicks, window dressing. So which can ultimately not known and hidden at one day could lead to failure unless detected by internal or external auditors. Again, subprime mortgage bets, large positions in securities backed by lower rated mortgages. So in the first half of 2008, lost 73% of value as credit markets continued to tighten. So when the markets tightened, then had to sell of 6 billion of assets and lost 2.8 billion worth of US dollars. If you look at in today's context, Sri Lankan rupees, how much? 2.8 billion, not a simple sum. Almost more than 500 billion. Bear Stearns, again a very old company. It's founded in 1923, showed large amount of asset-backed securities, including mortgages. So it's basically securitization company, issuing mortgage-backed securities. Father of mortgage securities. So the leading mortgage-backed securities company. Losses mounted in 2006 and 7 company actually increased exposure, especially to mortgage-backed securities, which were central to subprime crisis. And at the end, they sold to JP Morgan for $10 per share from 52-week price pre-crisis high of 133. So it was almost a share trading at $133 before crisis took place, but went up to significant low, but ultimately sold to JP Morgan at $10 per share. Barings Bank, and this is again famous operational risk failure. Most of you know Barings Bank in UK. Oldest merchant bank in London, so which is old as such as 1762, until its collapse in 1995. Even the Queen Elizabeth, second Queen Elizabeth, having her accounts in this particular bank before the bankruptcy. So collapse after loss from unauthorized speculative trades by its head of derivatives, Dick Deason. I think earlier during a lecture, I explained in detail how this operational risk factors led classically in this particular case to a failure. So operational risk coupled with market risk. I think earlier I explained to you. So it's a classic example of lack of segregation of duties and lack of controls by the banks and non-supervision by the regulators. So lost, Great Britain found 827 million. Instead of buying and simultaneously selling, lease and held on to the contract, gambling on future direction of Japanese markets. Internal challenges doubled as floor manager and the head of settlement operations. No checks and balance. It's a classic example of operational risk. Society General, Jerome Cavill, led to a $6.1 billion trading loss in 2008. One of the largest in the history. Arbitrage in between equity derivatives and cash equivalents. So he was basically betting on equity derivatives and cash equity prices. Wiped off almost 2 years of pre-tax profit of Society General's investment bank. So the profit it earned for 2 years was wiped off immediately as a result, taking unhedged positions far in excess of desk limits. So it has also gone beyond the limits set and which is unhedged, even above Mine's total market cap. Disguising exposure with fake hedges highlights lack of risk experts on risk committees. So remember, so he has engaging all these fake hedges, but which internal risk committees couldn't find. So it is again a question of governance, lack of risk knowledge by the experts in committees. States making a profit make hierarchy turn blind eye. Okay, so hierarchy playing a blind eye. JP Morgan, again losses on trading, even though not bankrupt. Derivatives bet made in CIO in London invest excess deposits to create interest rate hedge. Brought in 4 billion over last 3 years. Estimates could reach as much as 6 to 9 billion. Okay. So CEO Jamie Dimon under pressure. The pay of responsible officers to be docked, but ultimately no significant impact. Barclays, rate triggering scandal, which led to the CEO Bob Diamond being fined for $450 million and also possible criminal prosecution and Glass-Steagall type action possible. So it's a division between investment and commercial banking, and CEO lost $30 million worth of bonus. Royal Bank of Scotland, IT glitch caused breakdown of service to customers. Could they have tested on one of their bands and regionally before full rollout? Also fighting to keep LIBOR records private rate fixing scandal. So we can discuss many examples which resulted in failures or either near failure as a result of governance and risk management failure. So what to do? Who is to save us? Is it board, executive management, internal audit, accounting firms, rating agencies, regulators? But if you look at the examples just now we saw, sometimes you may feel everybody has failed. No one has saved. Boards have failed. Executive management have failed. Internal audits in certain cases have failed, but they couldn't detect. Accounting firms like Arthur Andersen failed. Rating agencies not given the true picture. Even regulators not being able to take action on right time. So risk governance. So usually the board directors have the following responsibility. So risk governance has become very important to ensure or limit or mitigate failure of any banking institution or financial institution. So usually the board of directors have the following responsibilities. The first, select competent board members and establish guidelines to govern the board organization and structures. So board should be very competent enough to carry out the tasks assigned to them. They should have good knowledge. They should be knowledgeable. You see, any organization, any entity, anywhere in the world, when you don't have competent people at top levels, it will lead to problems. So in organization, especially financial institution, given the nature of risk, board must be adequately competent in many aspects. Then you must have competent executive officers. You have to have the right team, right executive officers who run the organization. Experienced, knowledgeable, educated people. And also evaluate and compensate them accordingly. So it should be based on the performance, their ability, competitiveness, competencies. Review and approve the management development strategy. Okay, so it's responsibility of the board of directors to review and approve the management development strategy and overall risk appetite of the institution. Monitor the control of the environment. So again, monitor how the environment is controlled. Ensure that necessary corrective actions are taken to remedy the situation. So almost the responsibility to board, given any unwarranted risk event identified, possible risk event identified, possible incident identified, to take corrective actions. Ensure the compliance of the institution with the legal and regulatory. It's very important, especially in banks and other financial institution regulated. They have a dedicated compliance officer. So the compliance of the institution is ensuring compliance is a responsibility of the board. Directors are to perform these functions in the best interest of the shareholders and other stakeholders. Okay, directors are to perform these functions in the best interest of the shareholders and other stakeholders. Okay, so those are the responsibilities in a risk governance framework. So what the board of directors need to do, assume responsibility of leadership and control of the corporate. So they must assume the responsibility and the leadership and control. Direct and supervise the corporate affairs. So they have to direct as well as supervise the affairs conducted by the executive directors and the other senior management. Make decisions in the interest of corporate. Always, when you make the decisions, ensure those are for the benefit of the corporate. Sometimes you see directors take decisions not for the benefit of the corporate, but for the personal interest. So if you really analyze many failures, you have seen this. Regular meetings. You see, sometimes even though in our financial institutions, banks, where specific directions are issued, most of the banks and financial institutions follow them. You don't see many problems about these regular meetings. But in certain organizations where there are no specific regulations, you don't see board meet regulated. Sometimes there were no board meetings at all. So how board is aware of what is happening when they don't have regular meetings, when they don't discuss issues, when they don't call the senior management, executive directors to identify the problems? And also active participation. Having board meetings and attending board meetings is not enough. So all the members, board members, must actively participate and express their views freely, without any bias, openly. Freedom to include items in the agenda. So the board have independence or freedom to include items in the agenda, irrespective of what management thinks fit. And also, to get prepared for the meetings, there should be sufficient notice for board meeting. Otherwise, the board of directors cannot play an active role. So whenever you fix meetings suddenly, so you should have a clearly defined schedule of meetings so that you can adequately prepare for the discussion. Access to advice and services of company secretary and independent professional. So they must always access to advice and service of company secretary and independent professional advice. Again, full record of board committees, board and committee minutes and available for inspection. So always they should ensure board minutes are properly recorded, or decisions are properly minuted and available for inspection at any time. Then independent non-executive directors should be present at board meetings to discuss matters involving conflict of interest. So always when there are matters of conflict of interest, always independent non-executive directors should present at board meeting. So whenever you have a board which comprises at least significant number of independent non-executive, you have a better decisions without any bias. Because if you are not independent, anyway you have some bias. That doesn't mean you are acting always in conflict of interest, but there's a natural bias can come. And of course, executive directors' general bias is always there. And also abstain from voting if conflict of interest exists. Right? Insurance coverage in respect of legal action again. For any genuine act by the boards, there should be sufficient legal and insurance cover for any legal action. Okay. So what are the responsibility of chairman and the CEO? One of the most important difference, segregation of management of the board and day-to-day management of the corporate business. So there must be a clear difference between the role of the chairman and the role of the CEO. Sometimes it is not happening in certain organizations. A chairman is also tried to play a role of an executive director by intervening day-to-day activities, operations of the institution. So therefore, it is very important to segregate the duties. The balance of power at board level to avoid concentration of power in a single individual. So there should be balance of power in the board level to avoid control by a single individual. And separation of chairman and CEO. Division of responsibilities between chairman and CEO. CEO should be clearly laid down in writing. Otherwise, there may be interference at both levels. So chairman provides the leadership for the board, ensure the board works effectively and discharges its responsibilities, ensure good corporate governance practices and procedures are in place, Ensure all directors are properly briefed on issues arising at board meetings. Responsible for ensuring appropriate information received by directors. Encourage full and active contribution to the board's affairs. So always chairman give leadership and encourage active and full contribution to the board's affairs. Also get involved with other directors or the other board members to actively engage during the board meetings and express their views. Sometimes can happen. There are certain chairmen dominating so that other members don't get any opportunity to discuss or express their views independently. Ensure effective communication between board and the shareholders. Always the shareholders who are the owner of the company and who have appointed directors should be adequately communicated by the chairman about what is happening. Hold annual meetings with non-executive directors. Ensure constructive relationship between executive and non-executive directors, because executive directors always who are engaging operational activities have some sort of bias in certain activities they do or in certain decisions made by the board of directors. So there must be a good relationship. Board composition. So it should be a balance of skills and experience. So it should be overall balance. You must not have people only biased to a particular, if you take a bank, not all directors should be the bankers or experience in banking, but it should be a mix. There must be certain analysts, certain risk management people, certain lawyers, certain accounting professional people. So it's a mix. Balanced composition of executive and non-executive director. Also, while having skill, balanced skill and experience, there should be a balanced composition of executive and non-executive directors, because executive directors have some interest in the day-to-day operations, whereas non-executive directors don't have. And also, non-executive directors should be of sufficient caliber. So they must also have a sufficient caliber. Independent non-executive directors should be expressly identified. So among the non-executive directors, independent non-executive directors should be expressly identified, because they don't have any interest at all. But even if you are non-executive director, if you are not independent, then again you have some interest in the affairs of the company. List of directors updated and their respective role and function identified. Okay. So basically what it means is the board should have people with adequate knowledge, experience, with sufficient caliber. It should be a mix of executive and non-executive directors. Again, non-executive directors, it's a mix of independent and non-independent. Appointment, re-election and removal of directors. Formal and transparent procedure for appointment. So always when it comes to the appointments, re-election or removal, there should be a formal and transparent procedure for appointment. Succession. Whenever director leaves, there should be a succession, so that the operational flows are not affected. Re-election at regular interval, of course, subject to the relevant laws. Okay, relevant next. If you are eligible for re-election, so that has to be done regular basis. Proper explanation for resignation, removal of directors. Whenever company want to remove a director, so there must be proper explanation. Again, a specific term for non-executive directors, as you know, executive directors are part of the management who have, who are subject to the terms and conditions of the appointment letter, subject to certain regulatory requirements. But for other non-executive directors, clearly defined terms so that they are subject to rotations. All directors subject to retirement by rotation at regular interval. Okay, because whenever directors reach a particular age or beyond a particular period of service, should be subject to retirement by rotation at regular intervals. But with respect to the banks and finance companies and so on, there are defined regulations, directions with respect to the age limits and the service periods. Nomination committee be formed to make recommendation on appointment of directors and succession planning for directors, chairman and CEO. So in many banks or in many institutions, there are separate committees, especially nomination committees, to make recommendation on appointment of directors and succession planning of directors, chairman and CEO. So what are the responsibilities of directors? So by being appointed as a director, they can simply keep quiet. So there are greater responsibilities of directors of the organization. Keep abreast of the responsibilities as a director. So directors must aware their responsibility, what is happening, and must also look for the changes that are taking place around the world with respect to responsibilities, specifically respect to the institution which they hold the directorships and so on. And also exercise duties of care, skill, integrity, and diligence. So you must exercise duties of care when you perform your duties, skill and integrity and diligence. Ensure proper understanding of the operation, business and regulatory requirements. So there should be a proper understanding of operation, business and the regulatory requirement. So without having understanding, very difficult to make certain suggestions, recommendation as part of responsibilities of a director. So the directors must know what is happening. So there should be an interest in looking for that and contribute sufficient time and resource to serve the corporate. So they must have sufficient time. Now, sometimes you find the people appointed director board, they have so much other work, other activities, other functions. They hold positions in many other organizations. So they don't have any other time, or they don't have much time to spend on critical, functions of a particular organization, especially banks. So that's why in banking directions, I'm not going to discuss in detail. There are certain limitations. A particular director can, for example, hold directorships in a particular company. So there are specific limitations a director of a bank is subject to. Attend AGMs to share the views of shareholders. So it is very important directors attend the annual general meeting and share views of shareholders. Non-executive directors, So these non-executive directors need to play a greater role. Because they are not part of the management. They are not doing any, or they are not engaging in any operational activities, any decision making. So they must actively participate because their views are much more important than the executive directors sometimes. So they look at independently, bring in independent judgment, take lead if conflicts of interest arise. So they must take a leadership when there's a conflict of leadership because they are non-executive. So these non-executive directors also need to serve on committees. Now, for example, in many banks, you have audit committees, then risk management committees, whatever you call integrated risk management committees. There may be nomination committees, there may be remuneration committees. So they should be able to serve on those board-appointed committees. Monitor the corporate's performance in achieving preset goals. Monitor the corporate's performance. Information access by directors. It is very important the directors have access to information of the entity. Right? Sorry. So directors should be provided with accurate and appropriate information in order to make informed decisions and to discharge their responsibilities. Because the executive directors, especially, they have some means of access to information because they are within the organization or they are part of the organization. So they can get exchange information more regular basis so that they are well informed or have a greater understanding of the current issues and problems an institution face. But if you look at non-executive directors, they are not part and parcel of the management. So definitely, they can't make decisions without any information. So accurate and appropriate information to make informed decision to discharge their responsibility. Agenda and board papers should be sent in full in a timely manner to directors. It's very important. You should send the agenda. In fact, these are the roles of the board secretaries. So in full, in a timely manner to directors. Because if the directors don't get adequate time to read through these papers, they can't make active contribution for the decision making. But most of the directors are also working or maybe engaged in their own businesses or in certain other organizations. So they don't have full time for your entity only. So they must have adequate time to go through the papers. So there is active discussion in the approval process at the board meeting. Information supplied must be complete and reliable. So it should be, in order to make right decision, information supplied must be complete and reliable. Directors should have access to senior management for information. Whenever directors feel that they need more information, so they must be able to access the senior management for information. They can discuss with them. Information supplied should be of form and quality to facilitate. So this already explained. The quality of the information is very important. Otherwise, the decisions or the suggestions going to be made by directors will not be accurate. Okay. Any questions so far? Okay. So if not, let's move. Remuneration of directors and senior management. There should be transparency of directors' remuneration policy. So it should be a transparent process. No one can find fault with. The remuneration should be sufficient but not excessive. Okay. For the directors, basically, yes, only director fee usually should be sufficient but not excessive. Each director not to involve in deciding his or her own remuneration. Whenever remunerations are decided, each director should not get involved to decide his or her own remuneration. So there could be an independent decisions could be taken by other directors independently without any conflict of interest. So always in many large organizations, including banks, there are remuneration committees to be formed, mainly from non-executive directors. So they are independent in making remuneration decisions. Consult chairman or the CEO if needed. Also access to professional advice, market comparable information where necessary. Make recommendations on policy and structure of remuneration. Determine specific remuneration packages for all executive directors and senior management. So whenever it go through a remuneration committee, which is broadly independent, basically board committee, and also there is no bias as far as non-executive directors involved. Because whenever more executive directors involved, there could be a natural bias because they are part of this process. So access to professional advice, market comparable information. Again, review and approve the performance base. Now, always many institutions today, the remunerations are fixed based on the performance, not simple, enhanced remuneration. So that the management can perform well and achieve targets much more than a fixed rule-based remuneration. Review and approve compensation arrangement in connection with loss or termination of office, dismissal or removal of directors from his country. Very important. Again, okay, let me move on to the next area of governance, accountability and audit. Anything you need to clarify so far? Any questions? Little bit theoretical stuff. You feel sometimes boring, but this is part of the risk governance framework, so we need to discuss. No questions? Okay. Now, as I said at the beginning, so what are the key elements of governance framework? Transparency, accountability, many components. So accountability and audit. The financial reporting also plays a greater role. Now, if you look at the examples, we discussed the failures. One of the critical cause of failures are accounting frauds, accounting gimmicks I have highlighted in certain cases. So in that context, financial reporting plays a greater role. So management provides explanation and information to the board to enable them to make informed assessment of financial and other information. The board should present comprehensive assessment of the corporate's performance, position, prospects in annual and interim reports, price-sensitive announcement, and other financial disclosures. So whenever management submit financial reports, it is the responsibility of the board to do a comprehensive assessment in terms of many aspects. and the risk. Ultimately, all these end up with risk. All these end up with risk. So that it is very important, both comprehensively assess the performance. And also, one important thing highlighted here is the financial disclosures. Remember, the disclosures are very important to tell the markets or the public about the real position. Remember, market discipline, third pillar of Basel III. That is one of the objectives of informing other stakeholders of capital and risk part. But here, financial disclosures is much more than that. And accounting standards set certain requirements by law. Internal control, that's again important element, part of risk management. Ensure the maintenance of sound and effective internal control to safeguard assets. Conduct regular reviews of the effectiveness of internal control system, covering financial, operation, compliance, and risk management control functions. Now, many organizations, you have internal controls, but no assessment of the effectiveness. Just because you have something written in the form of operational manuals, guidelines, procedures, but it is very important during internal control process to see whether they are effective. And also, the internal controls must focus on preventing fraud, corruption, and malpractices. So if you look at all these previous cases we discussed, the main reason for failure is fraud, corruption, and malpractice. It could be accounting, it could be otherwise. So in any organization, internal controls are implemented in such a way that mitigate or minimize avenues for fraud, corruption, and malpractice. So you must stop. I mean, it may be good that, it is very good that if you can avoid 100%, okay, if you can avoid 100% fraud, that's fantastic. But at least if it is not 100%, to a great extent. So as I mentioned, the audit committees are there in many of your organizations. Have a clear terms of reference for the audit committee, a formal and transparent arrangement to apply the financial reporting and internal control principles, and maintain appropriate relationship with external auditors. So audit committee should have a clear terms of reference, what they have to do. I think all of your banks have audit committees, so they know what their role is. And it's a formal and transparent arrangement. Most of these audit committees are headed by a board member, non-executive, director, and mainly non-executive and non-executive and independent. Formal and transparent arrangement to apply the financial reporting, internal control principles, and maintain appropriate relationship with external. So they always have a dialogue with external auditors, again independent of the internal audit of the entity. It's very important audit committees keep full minutes, provided with sufficient resource to discharge its duties. So they should be provided with sufficient resources to discharge it. Independent from external audit. So this is not an external audit function, but these are independent functions. So mostly audit committees comprise or headed by a chairman, who is a board member, director, mostly non-executive, if possible independent. Then there may be other, people, and sometimes your risk people may be invited by the committee for certain decision-making process. So the audit committee makes recommendation for appointment and removal of external auditors. Again, now when it comes to the appointment and appointment of external auditors, so usually audit committees make recommendations looking at their past performance, ability and experience and effectiveness of the audit conducted of the institutions. They monitor the effectiveness of audit process, ensuring auditors' independence and objectivity, and also monitor the integrity of the financial disclosures, which is very important, the integrity of financial disclosures, oversight of the financial reporting and internal control procedures. So they do have oversight of the financial reporting and internal control procedures as well. And another important element of a board is the delegation by the board, delegation of the relevant activities. The formal schedule of matters specifically reserved to the board for decision. The clear directions to management as to matters requiring board approval before decision made. Okay. So all these directions to the management must be very clear, and also ensure they get also the approvals of the board before such decisions are made. Clear directions to delegation of management and administration functions as well as powers of management. So there will be effective delegation so that it is very clear who has to do what. Review the management for segregation of duties between board and management. So there should be a balance and clear segregation of what board is supposed to do, what management is supposed to do, and must review regularly to avoid any conflict of interest, and also to ensure clarity so that no one would do what is beyond what they have to do. So there's a clear demarcation of the responsibilities. Board committee to be informed with specific terms of reference as needed. So whenever the board's directors feel we need a committee for specific tasks, so those can be formed with specific terms of reference, with specific TOR, if needed. And also in a governance framework, one of the key component is communication with shareholders. Not just the shareholders, but even with other stakeholders. So in good organizations, especially banks, you must have a clear communication strategy to the two things. One is that you engage through appropriate communication strategy. You engage with the stakeholders regularly so that stakeholders know what is happening. They have some trust, confidence built on your organization. So that even if some adverse news create in the market, they will not adversely react because you have a continuous dialogue and they believe in your communication. Now, usually what happens, people start reacting for certain miscommunication is that you don't have right communication. Then they lose the trust, they lose the confidence, which will create unnecessary disturbance to the institution and to the markets. So similarly with shareholders are the owners because ultimately they have invested their money in the organization. So there should be ongoing dialogue with shareholders and make use of annual general meetings or other general meetings to committee. But if respect to the shareholders, you have some opportunities through the AGMs or other general meetings, so that they also know what is happening in the institution that they have invested. And also transparency in corporate governance practices and businesses performance through proper and adequate disclosures. So disclose them properly so that there's a greater transparency. And also always encourage shareholders' participation. So the board must ensure shareholders participate actively so that their views can be expressed. And also the boards can see how best their views can be considered for implementation or otherwise. Also, there should be separate resolution for each separate issue. You should not mix up. Chairman of the board and chairman of each board committees be present in general meetings to answer questions at any general meeting. So always at a general meeting, it is better that chairman of the board as well as chairman of each board committee. Now, for example, Audit Committee, Integrated Risk Management Committee, maybe Remuneration Committee. So the chairman should be present to answer any given questions. Chairman of Independent Board Committee be present to answer any questions in any general meeting to approve transaction requiring independent shareholders approval. So it's same thing, independent board committees like Audit Committee, Integrated Risk Management Committee, Remuneration Committee, and so on. Communication with shareholders voting by poll. If there's voting to be by poll, inform shareholders about the procedure for voting by poll, because there is a decision to be, or maybe made through a poll, then inform the shareholders how to do it. Ensure proper compliance to regulatory requirements about voting by poll. So ensure while you do voting by poll, proper compliance to regulatory requirement. Okay, so let's look at some governance principles set by the Basel, specifically with respect to the banks. So what are those principles? I think there are about 13 or 14 principles. I think 13 principles. So let's see what are those. The board overall responsibilities. So the principle 1 is about board overall responsibilities. Let's see whether we have anything. No, there are no details. And what are the overall responsibilities of board? I think we have already discussed in detail. So this is something Basel also has emphasized for the banks. The board qualifications and composition we discussed ample. The board should be adequately qualified, and there should be a good mix of people in the board with overall knowledge, background, experience, capabilities. So banks' own structure and practices very important. The methodology it follows and the good practices it follows. Senior management. So what is the role of senior management? What they have to do? Clearly mentioned. Governance and group structures. How the group structures are governed when you are part of a group. Now, always it is very easy if you are standalone entity. You don't have a group. Now, in the financial, especially banks and financial institution, problems comes when you are part of a group. For example, if you are a part of an insurance company, stockbroking company, asset management company, and you have some other manufacturing companies also within a group, then your structure is much more complex. It is very difficult to build up a good governance framework and avoid risk. So it is very important. The such group structures are governance properly. So this principle sets in financial industry when you are part of a group with you are the bank and there are other related intercompanies within the group having lot of financial exposures, and how you should deal with and what is the corporate governance structure. Then principle 6 about the risk management, the broad risk management. Then risk identification, monitoring and controlling. I think all of this we discussed in detail, but this has become a principle in the Basel corporate governance, under the Basel corporate governance principle. The risk communication, we just discussed the importance of communication, how that can help to minimize the what you call miscommunication, which could lead to risk. The compliance, I think we discussed in detail. I'm not going to repeat, but it's a principle 9. Internal audit, we discussed. Compensation, I think remuneration committees must be well thorough with compensation. What is the right compensation based on the performance? I think we discussed in detail disclosures and transparency. And what is not discussed was the role of supervisors. So the Basel Committee has identified in the case of banks, the supervisors also need to play a greater role to ensure banks have comfortable risk governance framework. So the supervisors adopt different methodologies to ensure that. I think all of you, as bankers know, regulators do conduct regular visits to your banks, on-site examinations, and see whether banks have good risk governance framework, and whether you comply with that, and whether you follow those procedures. And also, as a part of their assessment, they highlight to their boards. If you look at central bank regulators, inform the board, central bank board, that these are the issues that a particular bank faces with respect to risk governance culture. So these are the 13 principles set by the Basel for corporate governance. I think all 12 principles we have discussed in ample detail, but then I just now explain the role of supervisors. Okay, any questions so far? No one is talking. Hope you are with the lecture, or maybe you have left the lecture, I don't know. Little bit, uncomfortable because theory. Anything you need clarification? Few more slides to discuss. Okay. Now, I think we discussed many failures around the world. So, if you look at really these failures, and you can identify many root causes. These are common general causes. Okay. Or we can say governance issues. I mean, it could lead to many, these failures could be as a result of many issues, but what are the main governance issues? Risky business model. If you look at, I think one case, I think you see there's excessive growth. I can't remember. I think if you look at one case we identified, I think it was highlighted excessive growth, including what you call if you look at WorldCom, look at here, WorldCom, the comptroller David Myers, aggressive growth strategy, tried to merge with Sprint in 2000, which itself is an indication that high growth strategy has led to some problems. Okay, so that's the risky business model. I mean, not the excessive growth. The model is risky. Okay, so that's very important. Let me go back to the. Okay, so it's very important that you adopt the right model, not the risky model. Sometimes you find the models are not fitting your capacity. Now I will explain. So slight disturbance. Let me stop for a minute till this vehicle moves. Okay. So when you see certain failures, the model adopted by certain organizations are beyond their capacity. So which is called the risky business model. I will come to the Ceylon Bank case. You will understand this much more better. So it has led to some failures. So when you do the business, you have to identify what is the business model that suits for your requirement. Then fitness and propriety of directors and key executive. Always when you see the directors and key executives are not fit to do the, in the organization, that has led to certain problems. I think that's why it said so in the case of banks, the regulators have specified certain requirements for the directors. What is that? So let me ask a question. How they assure that, regulators? Anyone? In the case of Sri Lankan banks, how they do it? Are you in the lecture? Prasad, anyone? How they do it? Written proprietorness of directors and KMPs. Reshma? Anyone?
I think there is a separate direction for banks on
Yeah.
fit and pro.
Yeah. So the regulator, Central Bank of Sri Lanka, has issued a direction on fitness and propriety of directors. So basically, whenever a bank want to appoint a director, they need to get the approval. So the banks cannot appoint any director without the approval of the Central Bank of Sri Lanka. In the case of banks, they have to apply for a director bank supervision to seek approval. So there are set guidelines what is fit and what is propriety. Okay. Even in the case of finance companies, there are similar set of directions so that they have to get the approval of the director non-bank financial supervision institution supervision department before appointing directors. Okay, but what is more important is whenever you don't have fit, right people, proper people in the directors as directors, so this has led to some problems. You have seen many cases now. If you look at all these cases we discuss, sometimes it is gimmicks by not the right person, the wrong person. Okay, the compliance function. That's why in the banks and finance companies, there's a dedicated compliance officers by law, so that to ensure the compliance function is proper. High exposure to related parties. Okay, so you have seen many around the world, many examples, even locally. The classic example of failure of the Serenco group related companies, high exposure to related parties in local context. Okay, so that's the governance, because you always, if you follow the good governance principles, you should have minimum exposure to related parties. It's arm's length basis, right? Non-availability of dormancy of board, non-availability or dormancy of board and management. Sometimes boards are dormant. Management committees are dormant. Okay, even though there are committees, there is no active involvement by the relevant members. So it's just the name board. Also, regulatory arbitrage through related companies. Sometimes when the regulators prohibit banks to or limit certain, transactions of a bank, what they do is they use their related parties to do the same thing. So it is called the regulatory arbitrage. You see, so they avoid certain rules, but to do the, same activity which is not directly they can do. Ultimately, whenever uncertain, unexpected events take place, this will lead to collapse of the entire system. Dominant CEO and concentration of power among few key management. Sometimes in organization you see certain CEOs are very dominant, and also such CEOs have concentrated power among key few, management persons. So they are the team who take all decisions, no consultations, not listen to the other people's views. So sometimes it may be, leading to excessive risk taken by the entity, or maybe taking wrong decision, maybe fraudulent decision. So whenever you see this has been a root cause in many failures around the world. Dominant CEO. Even in previous cases, certain CEOs have been dominant. You can't discuss with them. They don't listen to you. Excessive remuneration to senior management. Whenever you have excessive remuneration to senior management, that also has led to some problems beyond the limits. Concentrated family ownership. Whenever your family your businesses are concentrated, or especially family ownership, lead to probably definitely significant governance issues and failures. So, but in the case of banks, at least we have some regulations that say you have to control the ownership, beyond which certain limits you can't have ownership. Poor conduct of board meetings, we discussed. No proper conduct of board meetings, no discussions, no avenue for discussion, in absence of policies and procedures. So there aren't, good policies and procedures in place. No one knows what to do. Absence of succession planning. So when you don't have proper succession planning, suddenly one of the important, key KMP leaves the bank. You don't know what to do. And also dominant. When somebody is especially dominant and leaves, that will lead to significant problem, because there is no succession plan. Who can take over that responsibility without getting the work disturbed? And also absence of clear reporting line. That's also again important. So in any organization, reporting lines must be very clear, so that there won't be any ambiguity in decision-making process. Inadequate internal controls. I think this is, as bankers, the importance of internal controls, and classic example is in internal controls and segregation of duties is the failure of Barings Bank. Classic example, UK bank. Absence of an independent audit. Now, even though sometimes you say you have internal audit, it's not independent. So it has to be independent. Poor management information systems. I mean, if you don't have proper management information system, we can get information much faster and accurate. Probably all the decisions the board is going to make is wrong. All the decisions or the recommendations the management is going to make wrong. So it's very important. MIS is, you have a strong MIS which can provide data faster and accurate. The poor risk management function. There should be a good risk management function which covers all key aspects which we covered throughout this course, all elements, so that risks are identified on time, measures are taken on time, the risks are monitored adequately, and controls are put in place on time, and with good communication with the relevant stakeholders. Strong risk management culture is important. The risk culture of an organization stems from its leadership. So leadership need to play a greater role to bring the risk culture into the organization. The board is to be understand, define, and actively manage its organization's risk appetite. It needs core of executive directors with solid business and risk expertise. So because board need to understand the risk properly, then what is the risk appetite? So you should have a core of executive directors with solid business and risk appetite. So they should, who are part of the board, who are executive directors, must be adequately knowledgeable about risk and business. The board members must not only be informed but also understand the risk return drivers. So they must not be only informed, but they also must understand risk return drivers inherent in major products, innovations, and concentration. Otherwise, they will simply approve certain products, innovations, without any adequate knowledge about the inherent risk. So that's what happens in many boards when they don't have adequate knowledge. Then board must understand and accept the consequence of major implementation decisions. So they should know whenever they take decision, what would be the consequence once those decisions are implemented. So before implementing, taking decisions, they must know the consequences. If they don't know, they must get adequate advice from the KMPs or the executive directors. So corporate governance failures, now I have given the causes of failure, just to elaborate what we discussed in run. So inflated earnings, so manipulation of accounting, information, so which is a root cause of failure. Then WorldCom expenses booked as capital expenditure. So whenever you want to capitalize expenditure, but you want to charge it to the P&L, but you capitalize, then what you do, you basically shows a rosy picture by way of profit and ultimately lead to a problem. Tyco USA, looting by CEO. So you see, dominant CEO, robbed the money, improper share deals. The Global Crossing, inflated corporate profits to defraud investors, you see. Then Royal Ahold, Netherlands, earnings overstated, accounting gimmick. Then Palmlet, Italy, false transaction record, again, accounting gimmicks led to the failure. The Walmart USA, weaknesses in internal controls have led to government investigations and class action lawsuits by employees. See, internal control failure. The Xerox USA accelerated revenue recognition. You see, instead of recognizing revenue properly, to boost the income, revenues have been accelerated. As a result, sometimes, when whatever I'm consequent now, when you boost the, revenue, ultimately leads the profit boosting, and probably the shareholders have been paid higher dividends, less retained earnings, which are not actual, ultimately could have led to the failure. Okay. So these are examples of failures that extract from this article, Reasons for Corporate Governance Failures by Shruti Mehta and Rashna Srivastava. Okay. Any more questions? Last part of our session, last few minutes. No? Okay. So let me take a classic case of risk governance failure in the Sri Lankan context about the Ceylon Bank. The case study Ceylon Bank. How many of you read this one? Anyone? Anybody? No. In fact, this is the, now after the problems of Ceylon Bank in 2008, Ceylon Bank was almost about to be bankrupt, but within a few minutes, couple of hours, with the measures taken by the central bank in 2009, there was no problem and no loss to the depositors. Nothing happened. Bank was able to survive within few hours, but it almost went down. But then 2009, the central bank annual report published is not just a normal annual report. It's like a storybook, which is called the case study. Ceylon Bank. I think all of you can read it if it is available. Small, it's not a normal. This is the annual report published after the crisis, first year of crisis, which tells the story. It's not just the financial statement. The new management tells the story about what happened. So I brought in as last part of my session to see whatever the things we discussed, risk concept we discussed, are classic practical example of these problems. So in December 2008, Ceylon Bank was confronted by a sudden, unexpected crisis of public confidence. So at that time, it was the fifth largest bank, while no doubt linked to widespread uncertainty in the wake of the global economy. Unfortunately, that time only the globe was also facing the great financial crisis, we call the global financial crisis, GFC, was triggered by a highly publicized financial collapse much closer to home. But even though there is no direct relationship between global financial crisis leading to problems in our financial system at that time, but this is a classic independent case where which went into problems. As a result, many concerned customers rushed to withdraw their deposit, creating a run on the bank. So the depositors went to the bank asking for their money. So it was almost banks about to collapse because bank was running short of liquidity. The ensuing period of instability threatened the very future of a 20-year-old bank because Ceylon banks, I think, started operations around 1987-88, and which is systemically important at that time because that is the fifth largest bank. Okay, so our task now is to look at what are the reasons behind this crisis. So which is not something I have written, but which is extracted from this particular book. So read this book. Book in the sense the annual report. So it says these are all which I extracted from the annual report stated by the board of directors after the problems. So Ceylon Bank was founded in 1987 and opened its doors for business on 24th March 1988 in Colombo Fort. From its founding, the new institution was part of the Selinco group of companies, I think most of you know, a major Sri Lankan conglomerate group operating in a wide range of industry. I think that was the leading conglomerate at that time. Rapid profitable growth. Ceylon Bank immediately enjoyed immediate success, reporting after-tax profit of 11.3 million for its first partial year, that is after opening business in 1987-88. The partial business, that is from March to December, recorded a profit. Over the next 17 years, the bank grew at an unprecedented pace with assets totaling 113.6 billion. By end 2005, that is after 17 years, profit in the same period fluctuated to some degree but followed the same overhead rapid trajectory, reaching 687 million in 2005. Okay, so significant growth. So the message it says is the growth of assets and profits were significant. Other key measures showed a similar pattern of growth. Okay, so other prudential indicators also showed a key message. The bank workforce increased steadily from an original staff of 72 to a company-wide total of 3,733. Started with 72, within 17 years went up to 3,733. A single head office location grew into a network of 117 outlets, based from 1997 onwards in a new headquarters, Selinco Ceylon Towers. By 2005, the Ceylon Bank was the Sri Lanka's fifth largest bank and ranked third among privately owned. So, if you look at the two state banks, which are the largest, then among the private banks is the third. Now, look at factors. Over expansion carries a price. In view of some stakeholders, staggering growth achieved by Ceylon Bank had led to a classic case of overtrading. So the bank has been expanding beyond the capacity without capital, without taking risk into account. Banking is by definition a capital-intensive business. However, in the case of Ceylon Bank, aggressive expansion both in terms of business volumes as well as physical infrastructure, not just the business volumes. It's not just the lending, but physical infrastructure. Opening of branches, expanding of ATM network, building new premises, had exerted tremendous pressure on the limited amount of capital available. You see? Now, usually the banks expand by the business, but it's not just the business, physical infrastructure beyond their capacity. Within 5 years of banks founding, its gearing ratio, degree of leverage we discussed, shot up fast 29 times. So can you imagine gearing shooting up more than 29 times within 5 years? So that shows excessive leverage, less capital. Ratio, in fact, remained extraordinarily high through the rest of the 90s and beyond, where other industry players typically hold gearing ratio below threshold or 15 times. The Ceylon Bank rarely managed to keep this gear indicator below 20 times. You see, whenever other players maintaining it below 20, Ceylon always couldn't keep it below 20. So that is a risk warning indicator. In retrospect, the one need only glance at a bank's financial performance highlight from early 90s onward to confirm the long-standing gap between business needs and the available resources. So it's a purely over trading, over expansion without adequate capital. Capital adequacy ratio, which had been consistently forced downward as growth in capital failed to keep pace with growth in volume. So capital adequacy continued to come down because the growth is expanding of growth is much significant compared to the capital. Beginning in 1993, the year it was first reported, this vital ratio was frequently below and never more than marginally above. Because at that time, when the Basel was introduced, it was 8%, minimum rate of 8% to 10%. Then Ceylon Bank just maintained that at that level or either below. Other warning signs. What were the warning signs? Ceylon Bank cost to income ratio highest in the industry. Highest in the industry. Ratio of non-performing loans range from 11 to 18% since reporting began in 1991 and was similarly among the highest in the industry. In addition to the shortfall in capital adequacy, there were other areas where the bank failed to comply with minimum statutory requirements. Not only the capital adequacy, even other minimum statutory requirement. Ceylon Bank was half the size of country's largest private bank in terms of asset. Now, at that time, when you take the largest bank in the country, private bank, the size of the Ceylon Bank was half. Let's say that bank had 10 billion asset, Ceylon had only 5 billion, let's say. But the Ceylon Bank had the same number of staff. How can it be? You see, for a 10 billion worth bank, you have 1,000 staff, whereas 5 billion worth bank also has 1,000 staff. So it's a over expansion, unnecessary operational expense. Operating expenses are very high in absolute terms as those of nation's large private bank. So the operational expenses are same as the largest private bank, which having double the asset size. Productivity gauged by assets per staff member and earnings per staff member was below the industry. So all these indicators were below the industry. So clear indication of improper governance. The profitability measured both by return on asset and return on equity fell significantly below the industry norms and below the returns posted by competing banks. Why? Because less capital, right? In pointing out these warning signs, industry experts drew some general conclusion about management effectiveness at Ceylon Bank. Clearly, there was a reason to question the quality of credit appraisals in the bank's lending. So it's a credit risk management problem. In the bank's lending and other financing, risk management practices likewise fell short of reasonable standard. So it's not up to the standard. The bank was significantly overstaffed, demonstrating a lack of adequate human resource policies and procedures. So there was no adequate, policies for the human resources. Equally apparent to outside analysts were more specific problems in one crucial aspect of bank's business conduct: its relationship to the Selinco Group, whose principal shareholder and chairman was also Ceylon Bank's chairman, Dr. Ali. So it has a related party exposure, which has led to some problems because it's part of the Selinco Group. Equally apparent to outside analysts were more specific problems in one crucial aspect. Okay, this is what I explained. So whenever I think I discuss in detail, one of the key problems in a governance failure is that related party transactions. So here you can see it very clearly in the case of Ceylon Bank. Okay. So then the Selinco connection, the related party connection. So Ceylon Bank had taken excessive and unjustified lending exposures with regard to many companies within the group. So over lending to the group, natural, you will have problems, natural. This is a clear example, not only here in Sri Lanka, in many parts over the world. Many failures. One of the reasons is related party lending excessively, not even at the arm's length. Had signed contracts deemed unfavorable to the bank's own interest in order to obtain services from or deliver service to a large number of sellers. So it's a classic example of interrelated lending led to the problems. Beyond the reasonable levels, beyond the reasonable terms, which paid a price, leading to the almost collapse unless central bank timely intervened and revived the bank in 2009. See? So why I brought this case, this is not something which I wrote. All these were extracted from that Ceylon Bank annual report in 2009, which is called the case study. So you can go through. So I have only highlighted few points, what is relevant to the risk part, which led to the problems. So in practice, you see these things. Risk governance is important. Governance and risk, not two terms, one term. The relationship is very important. Okay. So let me conclude lecture with this statement. Corporate governance is a dynamic process and is continually evolving. So the corporate governance is not static. What we discuss with respect to governance few years may not be what we discuss in today. It is evolving, dynamic. So practices are, evolving, processes are evolving. So the frameworks are evolving. And it has no boundaries or limits. So what we have to do as bankers or people who are working in institutions to manage risk, manage or develop governance culture within your respective organization so that you can mitigate any risk or you can meet any risk and you can bear many risks. If such risks arise, if you have a good risk governance framework. I think that's it for the day. I think that ends my part, all of my parts for this particular course as well. And probably you can continue with the other resource person for your rest of the series. And so basically I have covered the market risk part, the liquid risk part, and ultimately the Basel framework and the governance framework. Any questions? Okay, so if you don't have any questions, I'll stop for the day. So hopefully I will see your papers in the exam. Hope that you are thorough with what we discussed. Please go through whatever the areas we discussed and ensure you are comfortable with them and be able to sit to exam with courage and probably maybe end up with good results. Thank you.